Hello, and welcome to the first ever episode of the Baird 3C Group Money Matters podcast, a podcast for clients, colleagues, and community. I'm Alice Zalman from the 3C Group. Joining me today as host is my esteemed colleague, Dan Matthews. Dan, how are you today?
I am really good.
Good. Well, appreciate you here alongside me. Our goal in hosting this show and podcast is hopefully to help inform, maybe entertain, but provide some content that backs up our team's mission to be a great teammate for clients, colleagues, and community. So we appreciate you joining us. Hope you find the information helpful. We are very, very fortunate today to be joined by another esteemed colleague from Baird, Ross Mayfield, who's an investment strategist from Baird. Ross, how are you today?
I'm good. I'm happy to be here. Thanks for having me.
Good. Thanks so much for joining. For our listeners, Ross is an investment strategist with Baird Private Wealth Management, and you can frequently find him on national media publications, CNBC, Bloomberg, and the Wall Street Journal, among others, where he attempts to separate news from noise, help people avoid the chaos at times, and provide a common sense approach to markets, the economy, and investing. So, Ross, very glad to have you with us today.
Yeah, thrilled to be here. I'm in Bloomington, but we're in separate offices. It's this irony of 2025, right? The technology, we're so physically close together, but we're just a little bit separated. But I'm happy to be here.
Well, we're happy to have you, and thanks for hanging with us as we get up and running on this podcast. It only took us a short hour and a half to figure out the tech leading in to recording. So, Ross, we've got several questions for you today, which again, we hope help our listeners kind of navigate some of the news going on with markets and the economy. But something fun we want to try on this podcast for the enjoyment of our listeners and for us is to start by getting to know you a little bit and asking you, what is your favorite movie and why? But so our listeners know, the challenge for Dan and I as hosts is that we then have to try to work in quotes from that movie in a natural way throughout the episode. So without further ado, Ross, what is your favorite movie and why?
Well, and the challenge is going to be extra challenging because the two movies that I mentally brought to the table were WALL-E, which is a cartoon that I watch with my daughter and is a silent film about a robot for about 90 minutes. So that's got not a lot of quotes. And then my other one, mid-30s, so big Quentin Tarantino guy. Pulp Fiction is probably the one that resonates the most. And obviously that's about as R-rated as a movie can get. So I'll be very interested to see how successful you are in weaving quotes in a way that gets the movie and also satisfies the compliance folks that'll be taking a look.
Well, I've already thought of one. Can you tell us what's going on Wally Street?
I like that. That's good. I didn't think you'd go Wally first, but
I think that's
and again, that's about all he says.
Whole movie, right?
Yeah, it'll be fun. I like this twist on things, and thinking of my favorite movie, there's like so much content out there that it was honestly hard to kind of pinpoint one that has stayed with me for many, many years. Those two stand out.
Well, we very much appreciate you presenting us with a great challenge on a Friday morning. So thank you much. To get started with actual helpful content, Ross, obviously a lot happening with markets and economic news and data in the last few months. Much could change in the next several months looking forward. But could you give our listeners your take on some key issues that you're looking at, both from a market and economic perspective over the next, say, 3, 6, 9 months and beyond?
Yeah, absolutely. I mean, the two that come to mind that I've spent the most time talking about, reading about, researching are one thing that could be considered a headwind for the markets and one thing that could be considered a tailwind. And so on the headwind front, obviously, tariffs have been the big market story of 2025. It's been an unsteady rollout of the tariffs, a lot of uncertainty for businesses who have global supply chains or who sell products into other markets around the world. In 2025, it's hard to find a company, big or small, that doesn't have some level of exposure to an international supply chain, whether it's sourcing a raw material from Canada or selling their product into Europe or China. So the tariffs have been a big point of contention for markets. Obviously, in April, we had one of the biggest 4-day downturns that we've seen in market history, right? We have good data going back over a century. And when you're talking about the move we saw down 12% in 4 days on the S&P 500, you're talking about the kind of move you only see in a historic crisis, right? 2008, 2020. So a really traumatic event for the market. Now we've snapped back really aggressively as some of that tariff rhetoric has been rolled back. So a lot of uncertainty there. We can dive in as deep as you want to go, but then I'll say quickly the other thing, and the thing that's more of a tailwind and has given the market some lift over the past couple of years, despite all these headwinds, is this artificial intelligence, AI, trade, excitement, spending, investment, all of the things around this ecosystem. There's an excitement around a new technology, basically only rivaled by kind of the internet boom in the late 90s. And so that's driven tailwinds for the companies involved, but also great promise for companies in every sector and industry, including our own, to get more efficient, to get more productive with time, to outsource some tasks that can be done by an AI or a large language model, and free up, folks like ourselves, or again, the version of ourselves in any other industry, to focus more time and effort on the things that really matter to the business and the bottom line. So there's a lot of enthusiasm around AI. It's driven some really outsized gains in the market. Quite frankly, if you ask me, I think there's plenty of room for that trade to run. But 2025 to me is two things. It's tariffs and it's AI, and everything else kind of occupies a tier below.
On the AI front, one question or concern that we hear from clients somewhat frequently are concerns about AI replacing human jobs, human capital. You referenced this having a lot of similarities to the rise of the internet in the 90s and early 2000s. Can you speak to that concern a bit in terms of replacing jobs over time?
Yeah, so I can say that there is pretty definitively, just looking at history, there's never been a new technology that has been a net job reducer. New technologies change the kinds of work that exist in the economy all the time. I think something like, I'm going to butcher the stat, but a majority of the jobs that exist today simply didn't exist 80 years ago, 70 years ago, right? Financial advisor, investment strategist, TikTok influencer, right? These were not jobs that existed before technologies changed the world we live in. So there will be an evolution in how we work and what work looks like. But there's never been a technology, from the automobile replacing the cart and buggy to the internet changing the way we work, that has been a net job reducer. And we can look at the economic data today and see an unemployment rate of around 4%. Some of the wonkier stuff like employment to population ratios are near all-time highs. So to say that the economy today, this would be the first time in modern history where a technology was a net job reducer. So I'm not going to be willing to make the bet that this is that first time in history, right? It will change a lot of things, but I think it will also free up people in a lot of industries to focus on the deep work, the stuff that matters, and kind of free up time. So as an example, in my job, I work a lot in like Microsoft Excel, just pulling data, transforming data into charts or insights or whatever. The machine learning and AI models can do pretty crazy things with manipulating large data. So it frees up something that I consider busy work to do more deep work. You read about call centers, how much more efficient and better those employees are getting by having AI assistants. So it's early. We don't know what it'll look like. I mean, when the internet came around, I don't think that, even the people that were most on the forefront could have predicted what, the mobile technology we have in our pockets today would look like just 15 years later. So I can't say what it'll look like, but broadly, it would be one of the first times in history that a technology actually reduced jobs. And I just don't think that's going to be the case.
I had one question actually about the tariffs, and I was wondering if you had any insight as to the courts ruling the tariffs illegal,
yeah,
and how that might impact what's going on with the tariffs going forward.
Yeah,
I know it's being appealed.
Yeah, it's a great question, and it's a good caveat because this is happening underneath our feet right now. There was a court decision to rule that the powers the Trump administration used to levy the tariffs, which was this International Emergency Economic Powers Act, was illegal. The Trump administration appealed, and it looks like they've been granted a stay. So the tariffs will remain in place for at least a short time while this court ruling is debated. The big takeaway is twofold. Is one, we were rolling back a lot of the tariffs beforehand. So this might change the calculus of how the negotiations go to. It might actually weaken the administration's hand a little bit in some of their negotiations with other countries. But we were already kind of backing off the worst tariff impulse, and the market has rebounded as a result of that. The second thing, though, is there are plenty of other pathways for the Trump administration to levy tariffs with executive power using other codes of other trade acts. So the Trade Act of 1930 has a code in it. The Trade Act of 1974 has some code in it. And there are a lot of ways that the administration can use the trade representative, which is a part of the executive branch, to investigate other countries' trade practices and say, we deem these unfair, and therefore we can levy duties on that country. That's how we levied the tariffs on China in 2018 and 2019 during Trump's first term. So there are other pathways that the administration can pursue that don't need to go through Congress to get tariffs back in place on the countries they want them in place on. So it might change the dynamics a lot, and it's messy and noisy. And again, this comes back to the news versus noise, because I think it'll be a very noisy process that when we get to the end of it, we'll be in a somewhat similar place as we are today, with more tariffs than we had a year ago, but less tariffs than we had a month ago.
Ross, one question related to international trade. Obviously, McDonald's is one of the most recognized brands globally. Do you know what do they call a quarter pounder with cheese in Paris?
That's a Royale with cheese.
That's a Pulp Fiction vote.
Bravo.
Thank you. Thank you. Ross, pivoting a bit, one key issue central in our minds, as well as yours, I'm sure, is interest rate policy, the Fed, and how that may develop over the next several months or year. Obviously, without getting into politics, what are you looking for in terms of rate policy in the short term, intermediate term? Can you give us some insights there?
Yeah, absolutely. And it's a great question. And I think we need to break it up into two parts. So there's what the Federal Reserve, which is our central bank, what they do, and they very much control short-term interest rates. So if you're buying a treasury bill, something that's 6 months, 1 year, 2 years, even, what the Federal Reserve is doing has a lot to say about those interest rates. So the Federal Reserve wants to maximize employment and maintain price stability. So they're trying to always balance the job market and the inflation picture. And right now, they're very hesitant to reduce rates further because they're unsure what the tariff backdrop is going to do to inflation. So we had this big inflation spike in 2022. Everyone will remember that. And inflation has come down pretty markedly, but it's still a little bit higher than they want it. They target 2%. It's closer to 3%. And they really are concerned that tariffs, you add a tax to a company, that company is going to do everything they can to pass that price on to the consumer. However it goes, the Fed is worried that it's going to end up in higher prices for the consumer, and they are worried about cutting rates into that environment. Pulling back on the tariffs helps. Right now, the market expects the Federal Reserve to cut rates about 2 more times in 2025, which would take interest rates on the short end to a little bit below 4%. The other thing, though, is that on the long end of the curve, which is like the 10-year Treasury, the 20-year Treasury, the 30-year Treasury, are much more controlled by other market factors. So how the market views things like economic growth outlook, the outlook for inflation, and the fiscal situation in our country. So it is controlled by the Fed to an extent, but it's much more doing its own thing. And that it's important because the 10-year Treasury, for example, is the thing that derives a long-term auto loan or a 30-year fixed mortgage rate, the kinds of rates that a lot of consumers experience in their day-to-day life. So the Fed has been cutting rates, and the 10-year Treasury has gone up. So for anyone who was, ready to refinance or get into the housing market when the Fed started cutting, has probably been disappointed because rates have actually moved a little bit higher, or at least stayed elevated. So the outlook for the 10-year is a lot more in question. We're seeing it as we speak push up to higher levels than we've seen. And the 30-year fixed rate mortgage is at close to its 2025 highs. Again, even though the Fed has cut rates from last year. So all to say, The Fed, we expect to cut rates a few more times this year. We don't want them cutting too much because if they're cutting a lot, it probably means the economy is slowing in a way that's concerning. And then for the long end of the curve, that 30-year treasury, 30-year mortgage rate, it's kind of just been bouncing around. But the one point I'll make, and I can feel myself rambling, so I'll turn it back to you after I make this point, is that the environment of the 2010s where interest rates were really, really low, that kind of culminated with people being able to get a 3% or 2.75% mortgage in 2020 is very much the outlier across the bulk of history. So what we see today, rates feel high, but this is very much more of a normal environment, and I would expect that to stay. So whether the 10-year goes to 4% or 5% is somewhat immaterial in the broader, our rate's going to be a little bit higher for longer, and I do think that'll be the case.
So what I'm hearing is that the Fed's not dead, but Zed's dead.
Number two.
Two for two.
Done, Pulp Fiction.
Also Pulp Fiction.
Nicely done. Nicely done. One point I'll make on interest rates is I believe historically interest rates peaked in 1981, which is the year I was born. So I always like to tell people interest rates peaked in 1981, and so did I. So.
Yeah, I speak to a lot of clients, and when I talk about, a 6 or 7% mortgage rate being high, I can see the eye rolls in the audience from the people whose first mortgage was like 15% or whatever. But for my generation, that is extremely high. So it's all about perspective,
Ross, this comes up quite frequently as we're going through longer term financial plans, retirement plans for folks. But obviously, inflation's been a very hot topic in the news, and we've all felt the impact of that from grocery prices and beyond. Can you talk a little bit about stocks, owning stocks as part of your portfolio as a defense against long-term inflation, just to add some insight there in terms of how to think about it, in terms of having to take on some risk in your portfolio to try to combat that longer term?
Yeah, I think this is such an underrated point. I'm glad you brought it up. To me, stocks are one of the best, if not the best, hedges against inflation, because when you invest in stocks, you're not investing in like a nameless, faceless certificate or a tick on the screen. These are living, breathing companies that only exist to maximize profits in every way they know how. And so, in 2022, there was this whole narrative about like greedflation or profit-led inflation. And I think some of that is true. And for consumers, of those products, maybe there was some frustration. But for stock owners, for business owners, what that means is that your company is doing everything it can to maximize its profit margins. And if you own a stock in a company, at the end of the day, what you're getting in a dividend or a stock buyback or what the company is able to reinvest in the business is all what comes down to bottom line profitability. And if they're able to raise prices and get more efficient or cut costs to maximize profitability in an inflationary environment, you, the stock owner, are the one who benefits the most greatly. So, I always use the example with people of like, if you are a big fan of Chipotle and you eat at Chipotle and you're mad that the price of your burrito bowl went from $10 to $15 over a couple of years, and that eats into your earning power. But what that does to the Chipotle stock is their profits are going up. Now, again, you can be kind of opposed to that idea or think that there should be some cap on, what corporations can do in terms of passing on prices to consumers. But at the end of the day, you own stocks because you want to own the profit motive that is inherent in a capitalist society. And that means that in inflationary environments, you've got the smartest people in the world trying to navigate that environment as best they can. So it's a point I'm really passionate about. I think stocks are an incredible inflation hedge because at the end of the day, those companies are looking at, they see the full picture, they see the playing field, and they're doing everything they can to maintain their profitability in that kind of environment. Now, often that means passing price hikes on when their costs are going up. If avocados are more expensive, Chipotle is going to do what they can to pass those costs on. But if you own Chipotle stock, you're almost paying yourself back for that more expensive burrito bowl.
Yeah. And we should say Ross is using Chipotle hypothetically.
Right.
It may not be appropriate for any portfolio, but I think a fair point, and certainly a company that many of us know and are familiar with.
I might just be hungry. Yeah, I can't. Yeah.
Well, a Royale with cheese, I guess, is not an option. So Last question, Ross. We realize this may not be in the data that you look at on a daily basis, but again, one question that we hear fairly often from clients and others that we speak with is Social Security and concerns about the long-term viability of that program for Americans, certainly of my age demographic, not so much Dan's. He's a little closer to Social Security age than I. But any insights you can share in terms of obviously knowing that no one has a crystal ball or knows what the government may or may not do, but any insights you could share in terms of Social Security funding and what we may see or anticipate in the future?
Yeah, it's a great question. I get it a lot as well. So a few things I would say. First and foremost is you hear a lot about the Social Security Trust Fund and how much it has left in it, right? And that there are estimates, put out by the Social Security Administration and the CBO that the trust fund will be exhausted in sometime in the early 2030s. That does not mean that Social Security benefits will stop in the early 2030s. Just by payroll taxes alone, the government can pay something like 80 to 85% of benefits, right? So there's enough coming in from payroll taxes to get most of the way to the full benefits. So the trust fund, I think the exhaustion of the trust fund, if things were to be left as they are today, which is the next point, but if they were to be left as they, I think the idea of a trust fund running out is maybe not a scare tactic, but it's certainly when it's put in the headlines, I think is being used to get people nervous. So payroll taxes keep coming in. Most of the benefits or a high percentage of the benefits can keep going out pretty much into perpetuity. But the question is whether that's legal. That's way out of my depths. There's some legality question of whether you're obligated to pay these. And so if you're not paying the full benefits, can you? Is that even legal? So then the question is, what does the government do? There's really three threads in my mind they can pull on. You raise taxes to offset. You cut benefits or raise the retirement age, which is very politically unpopular. So that one seems, if I were just doing the betting odds, that one seems that it's a long shot odds, right? I'm from Kentucky, the horse racing's the long shot. Or you work into some tax bill or some sort of legislation where you can pull in funds from other resources. So a lot of the way we fund government spending is deficit spending. We borrow and we fund defense spending and, all of these things. So the question would be, can you start to pull in other sources of revenue or income for Social Security to kind of backstop the gap that has grown as the demographics of this country have shifted? So maybe the answer is some combination of all three. It's very difficult politically because cutting benefits gets you not reelected. Raising taxes makes it hard to get reelected. But there's a problem. There's a math problem, right? Which is that our demographics have shifted where there's, more people aging out, retiring, less people working, people are living longer. So it's a math problem. I would anticipate that the government will get something done because it's fairly untenable otherwise. But I do think that the key point to be made is that a large majority of the benefits can continue to be paid even after 2033 or whenever that date comes. It's all estimates at this point, just by the payroll taxes that are already in place. So it's hot button. It does get pretty political, but I would say that we have some of the best tax planners and financial planners at Baird, and they're all over this every single day. So I take my cues from them. And, again, it's pretty politically untenable to let this get to the end date and not have a solution. The way we deal with the debt ceiling in this country is often to get up to the finish line and then the market forces action, or just the anxiety of accidentally crossing that line forces action. So it may be that is a heck of a motivator for politicians, but that's still close to a decade away by current estimates.
Do you have a feeling for what our clients should do if they're trying to follow the path of the righteous man?
Is that number 3?
That's number 3.
That's number 3.
Well done.
I'm trying to remember what comes after it. Be something about beset by the inequities of tyranny, or I can't remember. You remember that line?
It's heady. Yeah, it's heady. I was trying to weigh in. You feel that's pride messing with you, but I couldn't get there. I don't know. It's such a quotable movie, but again, everyone I think of, I'm like, oh, there's a curse word about three lines into that one. So
yeah. Well, thank you for the insights, Ross, on Social Security. And certainly that's something if somebody does have a concern, as you pointed out, that our Baird team, along with our financial and tax planners, are in a great position to help navigate. So appreciate your insights there. Ross, we want to thank you so much for joining us today. It's a real pleasure. We're grateful to have your expertise and your common sense. Hopefully we can do this again sometime in the future. So we appreciate you joining us.
Anytime. Thank you all so much for having me.
Thanks to our listeners for joining us for our first ever 3C Group Money Matters podcast, a podcast for clients, colleagues, and community. Dan, thank you so much for your tremendous insights, Pulp Fiction quotes, and beyond. I thought we'd close this episode by asking if you have any good dad jokes you want to share. I'm sure the answer is no, as far as good dad jokes, but any parting insights you can leave us with, Dan?
Well, I did want to ask our audience and you guys in particular if you knew what the fastest growing capital in the world is.
I do not.
It's actually from Ireland. It's it's Dublin.
Not a bad joke. I think the delivery needs a little bit of work, but you get it.
I couldn't remember exactly how it went.
Well, thank you again for joining us for 3C Money Matters. Catch us in the future wherever you get your podcasts. We'll look forward to seeing you again soon. Thank you.
This broadcast contains the current opinions of the host and are subject to change. The broadcast is provided for informational purposes only, is not a complete analysis of every material fact regarding any company, industry, or security, and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. The information has been obtained from sources considered reliable, but its accuracy is not guaranteed. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. Baird is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. This broadcast may not be reproduced without express permission of Robert W. Baird & Company Incorporated, member SIPC.